Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. Today is December 11th, 2023. We are back with Season 4, Episode 9 of our podcast. I'm your host, Brad Wilson, joined by my colleagues Joe Fillimoney and Courtney Beach. It is our last episode of 2023, believe it or not, a year that is flown by, at least by my standards, it's flown by, with what seems to be, and we kind of talked about this just before we started recording, a lot of the same topics all year. We've been kind of sitting on the same topics this whole year. And so I think it's kind of good in this episode, we're going to wrap a lot of those topics up for the year, kind of talk about where are we at on a lot of the different news headlines, because the news headlines really haven't changed. Every month we seem to be looking for the same news headlines. Sure, there's different things impacting one way or another, but we're still sort of in the same landscape. So the big one sort of factoring in, which is a number and a headline that we factor in all the time, almost every month we're looking at on the news headlines, is U.S. jobs. So U.S. jobs numbers came out, big signal into sort of where the economy is heading, and it kind of smashed expectations, adding 200,000 jobs last month. So the market didn't really know how to react from that, and I think a lot of people are still sort of processing the news, but more than anything, the market got excited. And it could signal one of two things that I want both Joe and Courtney your opinions on. One is which is the one that the markets are running with, and a lot of people are running with, is the economy could enter into a soft landing into this recession. And the second one is that inflation's still sticky and rates are going to be a lot higher for longer, or even potential rate hikes we could see into the future. So, Courtney, what are your sort of thoughts on this initial numbers and where we stand on that front? I know we're talking U.S., but it does affect us worldwide here.
It does affect us. Well, some of the job numbers, you got to wonder if it's caused by Christmas. There's always a bit of a job bump in Christmas time for those seasonal workers. Um, but the thing is, I don't know if we're in for more rate raises. I think we've said this for months now. People are hurting, and it'd be very hard for them to justify raising it, especially because the Americans are going into an election cycle. So I mean, if they did raise it, it would be because they didn't have any other choice, to be perfectly honest. So I don't know if we're going to see that. Will it stay this high for longer? Quite possibly. I remember at the beginning of this year of us talking about them lowering rates at the end of this year, and that did not happen. So I don't know how much I could see us keeping at this rate for quite some time.
I'm kind of wondering whether some of those job numbers were skewed a little bit from prior months where there was some, striking strikes that were taking place, and people were, had reported officially unemployed, and now they're all back to work, right? So I think that might skew the numbers. But to your point, Brad, it just seems like the market wants to grab that and keep going and potentially look for that soft landing. But we know, and we've talked about this, a few times, the technology sector is really hurting. There's a lot of job losses that are happening there in the financial sector as well. We're hearing that just in Canada. So the numbers are a little skewed, but the market's just going to keep running with it ultimately. I think more it has to do with our second point, that it's more sticky inflation. I think that's what's going to end up happening here. And to Courtney's point, I don't think interest rates are going to do much in the ways of coming down. Maybe they don't have to go up, which is always good, but definitely not coming down anytime soon.
One important factor to note, sort of a stat that I saw when we talk about jobs, and yeah, maybe the strikes had stuff to do with it and whatnot, but the US numbers, they're at the lowest run of unemployment since the late 60s. So, you're seeing like record unemployment. And when I say like a run of unemployment, I mean month to month. You're seeing continuous low unemployment for a long period of time, which is just, they haven't seen that in, we're talking 80, almost 60, 80 years, right? Like this is 60 years plus here that you haven't seen this string of unemployment. So it does signal some strength, right? Like that has to signal something. that people are working. Like, it's not that people are struggling to find jobs. People are still hiring. Now it has slowed relative to last year, but they are still hiring. And that is where the soft landing camp gets sort of their positive news from.
I think part of the, those jobs there are sort of the new technology jobs as well, right? So, that's been our problem all year round in trying to find employees. And there's not enough employees to go around to fill jobs, mostly because a lot of them, shortly after COVID, left their job and went into some sort of new technology job, in terms of like a social media, manager, campaigner, or an influencer, right? I wonder how many of those numbers are influencers out there, right? So then, because a job is a job, but are they getting money? Are they getting paid? So that's my question. And how much are they going to get paid? Is will determine in terms of how strong the economy actually is.
Yeah, and I think like there is, and like when we talk about hiring, unemployment, there is still a disconnect. Like, this is not a broad based that every sector is doing well. So interesting enough, the most prominent sector for hiring in the last month was healthcare, government, and hotels and restaurants. So again, that restaurants and hotels things kind of leads into your seasonality thing, Courtney. I think that sort of idea with people are traveling, people are going out for dinner, celebrating special occasions through the holiday season. So I could see that. Government, an interesting one. And then healthcare, I think we've known that there's been a lack of jobs in sort of healthcare for some time. So that's no surprise. Yeah, all through North America for sure. So the ones, there was actually a few sectors: shipping, warehousing, and retailers actually cut jobs, which was an interesting, retailers heading into the holiday season, right? It was more the travel sector that sort of beefed it up, but retailers, and maybe that's a sign that we're shifting more to those online sales, right? That e-commerce, those brick and mortar retailers don't need as many staff even through the holiday season. I remember 10 years ago when Black Friday meant you watched the news to see how many people were piling on top of each other to get the TVs, the six TVs, right? That were for 85% off. And now everyone's at 12:01 p.m. refreshing their laptops to see who can get the TVs, right? It's different. You don't need all those security guards and staff to, I remember all those clips, right? You see in the US and the malls are just jam packed with people. That doesn't happen anymore.
No, I'm wondering to see in January and February when the sales numbers come out how Christmas was this year. Because I'm hearing from a lot of people just personally that they're doing leaner Christmases
Mm-hmm.
this year. They're just tightening up things because of their, the inflation. It costs more to
Well,
have the
that's it,
turkey on
right?
the
People are
table.
spending more on the meal than they are on gifts and whatnot. That's just a fact of the situation we're in right now.
Mhm. The other thing, though, to kind of circle back to something you said earlier, Brad, is how the market's not really reacting much to this stuff. And it makes me wonder what kind of investors are in the market. Like, if this is a lot of older people, who've been in the market for a while, they've seen the ups and downs, they might not be as keen to pull out because they've seen it before. Whereas the younger people, they're busy trying to pay off their mortgage or even get into a house. So maybe they're not as
Mm-hmm.
invested. So maybe that's why. I don't know. It's just a thought while you're
Yeah, it
saying
could be a
that.
demographic thing for sure. I think, we've seen it this year with high interest rates. You're seeing people make decision on investment properties, on mortgages versus investing, on lots of those conversations, right? So that comes up when you enter a higher interest rate environment, and that could definitely shift sort of the investor demographic when you come to that, because a lot of the retired, you could say, investors generally don't have mortgages right now. So um,
Hmm. It's just that we've seen this before and we've seen more of a reaction. And this time around, we're not seeing it, which begs the question
mhm,
why.
yeah. No, for sure. I think that'll take us to sort of our next topic, because we've kind of dabbled onto the interest rate decision. So, next news headline is Canada's decision on their interest rates, which was their final rate decision for 2023 on December 6th. So, last week they had the meeting. and they held rates. They held rates, stand pat, which I don't think surprised anybody. I think that was the consensus among most was that was going to happen. Um, they haven't closed the door on rate hikes. They haven't closed the door, and I think they're very, very cautious to acknowledging when they've closed the door on rate hikes for that reason. And we've touched on. I think Courtney mentioned, Joe, as well, that at the beginning of this year we talked about rate hikes. At the end of this year, now the big question is, when do we see rate hikes next year? And that's what everybody's crumbling for, because you've got a lot of variable rate mortgage holders that are renewing, or variable rate mortgage holders that have their variable rates. A lot of people who are eyeing their renewals in 2024, wondering what are they going to have to renew at, because these are people who bought in 20, or likely if you got a 5-year fixed, were 2019 mortgage holders where the rates were around 3%, 3.5%, 4%. So you're looking at least a 1.5% to 2% increase on that. So where's that heading? And I'm seeing a lot of disconnect between what realtors are saying and what economists and analysts are saying. I see realtors saying Q1 2024 rates are coming down, and I see analysts saying we're going to see rate cuts next year, but Q3 or Q4. So we're almost a year away from them. So what are your guys' thoughts on the rate cycle?
Yeah, everybody's trying to be a fortune teller all of a sudden, getting out their
Yeah.
crystal ball.
Well, and part of it is a self-fulfilling prophecy, right? If you say it often enough, it's going to happen. And as a realtor, you would want the rates to go down so that you can still sell houses. So I can definitely see that. But I think it's going to be very, very cautionary. I think the central banks, both here in Canada and the US, are not going to be quick to drop rates, even if we slide into recession, even if we get a lot of unemployment. I think they might just hold things a little bit, try to get that inflation rate down. And yeah, it's going to certainly impact a lot of people. In addition, as you said, if they are concerned about their job, and then all of a sudden now they're concerned about their mortgage renewing, there's going to be a lot of houses that are going to be up in the market, and you might start seeing that. But certainly now we're not seeing it. We're supposed to be a very December, very quiet real estate month, but you still see lots of listings that are happening, and some houses going for more than asking. So I think there's still a bidding war that's happening, at least here in Canada on the local level.
Yeah, the last the Bank of Canada wants to do is lower the rates just to raise them again. Can you
Oh my
imagine
gosh, the
the
turmoil.
PR nightmare for them to do that? They want to make sure they're doing it right. So they'll hold to make sure those numbers are where they want them to be before they'll
Yeah, I'm
lower
in the
it.
camp that they're going to hold rates too long. I think they're going to hold rates to err on the side of never having to hike anytime soon again. And they'd rather do it to do a little bit more damage to the economy and, cause a little bit more stress and pain than to hike them early and see inflation back up at 4% next year, 4.5% next year, right? Like that's the last thing they want to see, is to get all this work, cause all of this turmoil just to do it all over again, right? And I think the issue we run into when we talk about this is really one of the only, if not the only, tool that they've got to try to ease inflation and wrestle this down. And we're sitting in a housing shortage in Canada. So all you've got people doing is you've got people staying at home, living at home longer. You've got people who can't afford rentals. Okay, prices are going to come down, but you've got these people saving up money at home. I know it's not everybody, and people are in different situations. The cost of living is still expensive, but I think we're noticing there's more and more people living at home or cohabitating with different groups of people, 4 or 5 people renting a place, saving their money, that are just waiting. They're waiting until they can qualify for a mortgage. Well, what does that mean? Is they need prices to come down or they need their down payment to go up. And one of the two is going to happen. And you're going to start to feel a trigger point, I think, when interest rates do start to fall, of people jumping on those houses. And there's going to be, like you said, Joe, a bidding war, I think, at all levels. I don't think we can get away from that because there is a shortage of housing and people need places to live. And I think you have investors, especially real estate investors, who might be saying, I'm just done with this. I don't want to do this anymore. When the market starts looking good again, I'm out. These properties are gone. I'm out. That's it. Right. And so you're going to be, I think we're in a weird environment where even the slightest rate cuts are going to trigger that, and that's why the Bank of Canada is going to hold on a little bit longer into next year. I even say I'm not even 100% sure they're going to hike or they're going to cut rates next year, right? We might have to go the full year at these current rates before they hike, and they may hike quickly after that. But I don't know. I feel like there's a snowball to come as soon as that rate hike comes. I know there's going to be 8 realtor posts on Instagram and Facebook about time to buy, time to buy, time to buy, right? And people who've been on the sidelines waiting might be going in.
And I think the government is trying some other programs too to kind of encourage more, rental properties. And I know they're doing the HST rebate. They're increasing that for rental properties for landlords to kind of build another house. I think there's lots of incentives for converting your basement into an apartment and stuff. But those will take a lot of time to kind of flow through the system, right? They're not going to happen overnight, and maybe we'll have interest rates back to sort of I would say lower norm, and more manageable for a lot of the people with the big mortgages. But those other incentives will certainly take a lot of time to flow through the government.
Yeah, and I was looking it up out of curiosity, and uh, apparently $186 billion worth of mortgages are set to renew next year, and that seems like a lot, and it is a lot of money. But then in 2025, it's 315 billion. So a lot of people have taken advantage of those low rates when they could, but at some point they're going to have to renew. So Bank of Canada has a crunch time to kind of get the rates down so that, because otherwise, with those people come up for their mortgage renewals, are they going to be able to afford to renew? That's the
Yeah,
question.
it's going to be interesting. I think uh, the interest rate decision on on where we go with that is just going to be the continue to be a hot button issue for all of next year. I think just given the volatility of rates from this year, next year, now every meeting they're going to be looking for a cut, right? This year we are all wondering, okay, are they going to hike? Are they going to hike? Next year it's going to be there. Are they going to cut? Are they finally going to cut? Are they finally going to cut? And so it's going to be almost the reverse, and we'll be interested to kind of watch how that unfolds um, next year, because there is going to be lots of pressure on people who probably didn't think they'd be renewing at a 7% variable rate, um, you know, or 6% fixed rate. I know I've seen some a little bit lower with sort of anticipation of rates dropping, but it'll be interesting to watch for sure on that.
Yeah, and to reiterate, I think we said this in previous podcasts. We have in Canada seen rates double that. It's just we've never seen the balance on the
Correct.
mortgage piece of paper that we have to go
Yeah.
along with
So
it.
it'll be interesting to see how that impacts pricing too, right? Like we've kind of already touched on housing. I know we want to talk a little bit more on it, but it will be interesting to see how that affects pricing. Like you mentioned, Joe, we're still seeing how there's demand for the houses, like I mentioned, right? And there's people still willing to pay that amount. And I think as time passes, you've got good available rates for short-term savings right now. People are taking advantage of that, put parking money there to, when the time comes, splurge on that house, get that house that they're looking for. So it will be interesting to watch that. So let's move on to sort of markets, discuss the markets. We touched on it a little bit at the beginning. What does the market outlook have as we head towards the end of 2023? And then we'll shift focus to sort of what do we foresee and what are people, analysts and experts saying when it comes to 2024. So first, closing out 2023, market rally. Like I said, lately, a lot of big push on the soft landing aspect of things. Markets are pricing in rate cuts at the beginning of next year. That's what the expectation is right now. So I think there's a lot to lend itself to where does that go, which is what we just talked about. But what are your sort of thoughts on where 2023's been and where the markets have sort of led us to the next sort of 2.5 weeks to close out this year?
Well, it's always kind of nice to end the year on a high note. So I know I'm always happy when I see my statement at the end of December and it's a good return. So I think a lot of people would be happy with that. And I kind of sense that we're in that Christmas sort of market right now, and everything's relatively positive. So I still maintain that we probably will hold to the end of the year, unless some really drastic news comes in. Like the market has to come to the realization that, hey, yeah, we're kind of slipping into recession here and
And
stuff,
technically,
and
we
the
are
rate
in a
cuts may
recession in
not be
Canada,
coming.
right? Like technically,
Yeah,
we've had
true enough.
the quarters of GDP negative growth, right? So technically, we're there. It's just
Yeah,
how far do we fall into it, right? And there's lots of anticipation that
yeah,
we're going to bounce right out of it right now,
yeah.
right?
Yeah, comes out to, to our point of soft landing or not soft landing. And there's still a lot of analysts that are out there that maintain it's going to be a hard landing. Like the markets will, correct, but it's anybody's guess when it's out there and stuff. You look for those indicators, but it's anybody's guess. But from a consumer point of view, it's always kind of nice to see that statement, you know, on a positive note at year end.
Yeah. Yeah, and so when we look ahead to sort of 2024, I think a lot of eyes are on the bond market right out of the gates because the bond market sort of can somewhat tell where interest rates are going, what the yield curve's saying. And then equities, I think, are just volatile on news right now. I think there's a lot of volatility on news. And given that interest rates and to that effect, bond prices are going to trigger a lot of equity movements, especially at the beginning of the year, given sort of the expectation around rate cuts and where we're trending in that direction. So it'll be interesting to watch. I know there's a lot of people that are cautious, like you mentioned, Joe, sort of tiptoeing over the fact of, okay, all these people excited about a soft landing. We got to, but there is some caution to be had as we sort of enter the new year.
Mm-hmm. Yeah, it's certainly going to be interesting in 2024, and to see what, the markets sort of feel at that point in time, how they are kind of digesting all this information that's going on, what sort of job numbers that we start seeing, whether we still see, some job losses in those key economic indicator industries that we talked about there, the shipping, the warehousing, and areas like that. So it certainly will be interesting how it's going to interpret that information and then respond accordingly. Because ultimately, that we're at some high points in some positioning, right? Like, so at some point in time, someone's going to say, "Okay, I think it's enough. I'm going to pull out," and it's going to start. It's going to start like a whole cascading event.
Mm-hmm. Yeah, for sure. I think a couple things to watch sort of for next year. You look at like commodities, you look at geopolitical kind of issues as well. We're, believe it or not, like approaching almost 2 years on the Russia Ukraine war, and that's still ongoing, but it's not really talked about as much anymore. It sort of fades out. We get that news so instantly now, and that still fades out. That has direct implications on the oil supply. There's lots of fears that there's an oversupply of oil right now. You've seen a big decline in oil recently. You've probably noticed that the gas pumps were down significantly here in Canada. I think where it's almost 30 or 40 cents from where it was a few months ago. So you are sort of seeing that decline in commodities due to some of those issues. And then obviously you've got the recent sort of Israel and Palestine conflict in over there. Like there's a lot of turmoil globally right now that it always has risks when it comes to where we are now and what lies ahead for us. So lots to sort of watch on that front. So that moves us into kind of concluding this final podcast of 2023. Joe, what is your financial planning tip of the month?
Well, yeah, as it's end of the month, end of the year here. By the time this podcast airs, we're like deep into Christmas, and so some thoughts. You'll still have a few days, in terms of looking at any donations that potentially you might want to make. Donations not for everybody. I realize it has to deal with your cash flow, but if your income is relatively high and stuff like that, consider doing some donations. There's great tax incentives from the government. There's some decent tax savings, especially if you did some in-kind donations with some of your investments. So talk to your financial planner about that. It's a great strategy that works very, very well. At the same time, think of 2024 and it's time to start again, right? And just start thinking in terms of some changes that you might want to make, on your investment side. Again, talk to your investment person, your financial planner, and get early going on those. Remember that in the first 60 days of 2024, you can make an RSP contribution that will affect your taxes for 2023. So that's a good thing to kind of look at. And just head into 2024 on a positive note.
Awesome. Thanks, Joe, for that. And yeah, big thank you to everyone who listened to this podcast throughout 2023. Wherever you are listening and or watching, please do subscribe, leave a like, rate 5 stars, whatever you can do. And we will be back with January edition of the podcast to see how the new year kicks off. Wishing everyone a happy and healthy end to 2023 and a great start, prosperous start to 2024. We'll see you next year.